if you had asked anybody before this evening how Wall Street would react after the U.S. decided to directly attack Iran, I'm guessing the thought would be more severe than this.
I think that was the thought coming in. But remember, we had a taste of this when Israel first struck Iran back late June 12th here in the United States. And I think the playbook that is going to play out tonight and into Monday could potentially be a repeat of that. A big knee-jerk reaction where risk assets get sold off, haven assets get bought. But then a quick rethink here. And that rethink, Joe, is all around this idea of whether this is a regional conflict that will remain regional or something that could broaden out to hit U.S. assets or even something beyond the Middle East. If that were the case, you would probably see more of a severe reaction. We should point out oil prices did move higher by about 4%. They pared back some of those gains, but are still up almost 3% here. Brent crude, remember, hasn't actually traded above $80 a barrel since early this year in early January. It did do that early in this session, and that is going to be a key number to watch. And of course, what will dictate whether it sticks at 80 or goes beyond that is really going to be determined by what happens in the Strait of Hormuz. But real quickly, I do want to just draw your attention back to equities for a second, Joe, because there is a contrarian bet out there right now. And the contrarian bet is that right now, if you are able to get confirmation from a credible source that the nuclear threat of Iran was indeed obliterated or at least significantly hampered, that would actually remove one of the biggest risks to Middle East stability in years. And that potentially could be a net positive for stocks. And the case in point is I would just point you to the benchmark index in Israel, the Tel Aviv 35.
Yeah,
that closed today on a 6-day run at a record high.
An excellent point, Romaine. And as we consider other asset classes as well, I wonder what we expect to see in U.S. Treasuries, knowing they are seen as a safe haven, but also if there's a concern that potentially higher energy prices could lead to higher inflation risk, that could send bonds in the other direction. So what are we hearing about how all of this factors into fixed income? Yeah,
the Treasury market is really going to be kind of the Jenga game that this market's going to wrap its head around, because it's really not just about what's happening in the Middle East. It's obviously what's happening with the fiscal situation here in the U.S. And as you just alluded to, this idea of economic conditions and inflation conditions. Whether the Middle East situation feeds into that, we will see. The numbers you're looking at on your screen right now, keep in mind here, this is an incredibly muted market right now. The full session really doesn't open for another hour and a half here in the U.S. Futures, at least as represented by TYA, and if you type TLT, the main ETF that tracks long-dated bonds in your screen, you'll see that the activity is almost minimal at this point, very low volume and very little price change, but that could change, Kelly, in about an hour and a half's time.
What you just said, Romaine, was really fascinating, pointing to stocks in Israel. If we show up tomorrow, we still don't know for sure. Does the market hold its breath until we find out what the actual damage assessment is in Iran?
Well, I spoke to several analysts this afternoon, and two things that they said they're really keeping an eye on. The first is obviously what is Iran's response, if at all, and more importantly, how severe can that response be? But the other thing, too, was to really keep an eye on this idea of trade flows, the ships coming in and out of the Strait of Hormuz, the ships coming around the Red Sea, the ones that are around the Horn of Africa. If you see major disruptions in those areas, that would probably be cause for an alarm. You would first see that play out in the commodity space, and then that would trickle over into FX and then eventually into equities. But short of that, the general consensus seems to be that you might have some softness on Monday here in the cash session, but that could potentially be bought in the same way that we saw stocks get bought after the sell-off on June 13th.